Hey, good afternoon, everyone. This is Trader Tim from over at EminiMind.com, and we're doing a Monday market analysis video. Today is August 22nd, 2022, and the theme of today's video is going to be about market context and some of the uh, more subtleties that come into play as far as my decision making when it comes to taking a trade or not taking a trade. So I wanted to run through a couple of trades today, Friday. Um, and kind of a few other things that I've been watching that I think you'll want to pay attention to. So the first is the large 50% retracement um, going from all-time highs down to our swing low in July. And you can see we are on the ES just moved below the 50%, the 42.23 this week. And if we go to the daily chart, Friday's close, I did buy some puts at the close on Friday, and the reason I did that is because we had our first kind of what I would consider bearish close um, in really a long, long time. The close here closed at the 50%, but I didn't feel like it was that bearish because we were closing above the prior day's close and the prior day's high at that. So even though the candle on the 11th was a bearish candle, we still closed above the prior day's high, whereas Friday's close was it was a bearish candle, but it was below the prior day's low and the prior day's close. So some context there of, the candle not just on the day itself, but how it relates to the prior day is a very helpful tool. If we go back to like here, you have a bearish close, slightly bearish close. I mean, we are just barely below the prior candle's low, but look at this cluster of consolidation. We're just kind of closing in the middle of this range. So that in itself is not a very bearish candle. Also, the fact that it has a close and open price that are near each other, not super bearish. This day, actually, the 26th, started to set off a little bit of a red flag of, okay, are we going to get some pullback? We were also, you can see here, at the negative 23.6 here. But the pullback itself, at that point, we were already, you know, if you look from the negative 23 to the 50, that was like already halfway back. So most of the move, or a good chunk of the move, had already happened, and we didn't end up going to the 50%. But I didn't find that it was an opportune place to buy puts at that point. And at this point as well, all of the news that we've been seeing, good, bad, it was all sending the market higher. And so not a lot of bearish follow through. Whereas on Friday, towards the end of last week, even the middle of last week, there were some decent news reports as far as inflation goes, or just not outright bad. And the market didn't rip. We had some of these smaller body candles, and so that's sort of a slight turning, if you will. But look at the pullback now. The pullback is taking us to this consolidation area. If we draw a box around it, looks something like that, and that's where the pullback is here. So I took off some of the puts here at the close today, just to kind of lock in a little bit of gain and ensure that the position isn't going to go against me. But if we go to the bottom of the range of this kind of shaded box, I wouldn't be surprised if we get some kind of a bounce. I'm not going to come in here and try and pull every single 50% retracement off of every single swing low. You could use this swing low here, swing low here. I would just go to the full halfway back and use that as a reference if we sell off. And it's basically the 4,000 level, 39.83, but plus or minus 20 points. We're talking 4,000 on the ES if we were to sell off. And so I'd watch for us to kind of, if we do go lower tomorrow, for us to move down towards this 4,000 level and maybe ping pong between those two 50%. Let's see, moving on to some intraday stuff. Oh, well, before I do that, just wanted to pull up the gap chart. We have a couple of unfilled gaps now above us that we didn't have just from the last couple of days on the move down. And then the next one down is all the way at 39.32. So that 50% retracement, that would be down, close to the 61.8, not crossed below it, but certainly would take us to that halfway back point. And then the last chart here, the trend line chart, you can see the prior swing low would technically be back here at 41.13, and then the swing high 43.27.50, and then this was that uptrend line that I had on the chart as we were moving up. So closer to breaking the swing low than breaking the swing high, but we'll see how the next day or two trade in terms of market sentiment goes. The VIX bounced a little bit, didn't make it up to the underside of the trend line yet, and it's still pretty low, but we do have a corresponding rally in the VIX with a sell-off in the S&P. So that sort of confirms, yeah, the pullback is legitimate, if you will. Because sometimes you get these pullbacks and volatility does not spike, and then we just turn around and we get something like this, where we get a one-day pullback and then boom, we gap up the next day. So let's look at the intraday. Today's trade was a short. And, oh, let me switch this over so we can link the charts. On toss, if you have your drawing sets called the same thing, then when you draw your lines on one, they show up on the other. So like now, if I scroll over to this tick chart, those same lines are on the chart. So this morning, let's see. So let's start with an icy tick and then move over to the trade setup. When you have, going back to the theme of context, when you have open where you have all of these extreme nicey tick readings, just ignore those, like the first 5 minutes, and start your low of the day, if you will, after that 5-minute mark. So like 650 Pacific was, for all intents and purposes, the first low tick of the day, low-ish, if we're gonna be technical, because technically the lowest tick of the day happened right at the open. But if we ignore those, a low tick came at 650. And so last week we talked a little bit about the idea of going long on a low tick, like on a minus 1,000 tick, just getting long when that happens. There's a couple of ways that you can do it. You can wait for a swing high to break. And in this pullback, there really wasn't a swing high until all the way up here. Here you had one little green candle, but it really wasn't much. So the swing high to break would be all the way up here. Well, that's a long ways away. You can also just ignore that swing high criteria and just draw up the first micro long and try to get in as close to the low as possible. And so drawing up the very first retracement long needs to be really small, but sometimes that can get you in, or just buying the low tick. But it needs to be extreme. It can't be like a minus 200 or 300. It needs to be like minus 1,000. We had another one later in the day at 7:24 my time, and that was down here. And you can see, okay, if you bought that 7:24 low tick, you got a little bit of a bounce. If you bought the first 50% pullback without the swing high break, you got at least enough for a first target and a bounce. But if if you're looking for the swing high to break, well, that would be the bigger change in trend, the bigger confirmation. That did not happen, and what did we do? We rolled over. So we made another lower low. So certainly taking a 50% retracement without a swing high break is more risky, and just buying the low tick itself is more risky, but you don't get that many minus 1,000 or plus 1,000 ticks. So if you give yourself a little bit of wiggle room and build it into your trading bullets for the day, if you will, there are some opportunities to catch a quick move. You don't want to just take a point out of it, but if you're using a point and a half or a 2-point stop, and you can get 4 points out of it, okay, that's a decent move. And if you can trail and kind of stay in it longer, you sometimes catch the low of the day. But going back to straight up retracements, what we normally are doing day in and day out. First bigger retracement on the day look like this. You could either use the high here or the high of the day. Either one kind of sets you up in this 50% short. We had that kind of low-ish tick of the day here at 650. We broke the 60-18. I chose not to take this one as a short. It was a nice setup, but with that lowish tick, I thought, okay, maybe we'll come down and instead of go into a triangle. We didn't really do that. Rolled over and it worked out, but I didn't take that one. But again, context and kind of what's happening around the trade. Then the next one here was like this. Also notice how it went through the 60-18, through the 60-18. So they were a little bit dirty, but they still rolled over. But then it was this third one. And the reason, the context for this trade, is because it lined up near the bottom of the 30-minute range. We broke down on this prior push down. We broke down below the 30-minute low and this cluster of lows at 41.63. And so this bounce, 41.64.75, I felt was a nice short opportunity. And then just trailed the next retracement. First it looked like that, and I drew it down like that, and then trailed the 60-18. And then when that one rolled over, I just trailed the next 60-18. And then when we started kind of nose diving here, I just came in and trailed each candle by like 2 ticks as best I could. It started moving a little bit fast in here, so I ended up with, it was 41.56.50 is where I ended up getting out, so like over here. So not, the low, but close enough to it. So that was a nice way to start the day. I always like, Monday, if I can get one nice trade to start the week, that's fine with me, and I'll just call it quits. 15-minute trade today didn't really do anything. It ended up, it broke lower, but then so this first 15-minute candle here, it broke below. The first 15-minute candle's low, but then it bounced a little bit, and then it rolled over. But I did want to highlight Friday's 15-minute trade because that one went for a nice plus 20 points. I just went back to doing the old way of using a -4 stop and a plus 20 target, and then basically walking away, not doing any trail stop or tightening of my stop along the way. I just set it at -4 as my stop. It got in. I can show you. It went like 2 points of heat here. So this was the close of the bar. It broke down rather quickly after the candle closed, and then moved up 2 points of heat, and then rolled over, and then took a little while, but eventually, if you just ignore all the chop, basically the 47.75 down to a 27.75, about here, got you your 20 points. So I'd been noticing that using that +4 adjustment of the stop, there were more trades than I was comfortable with. There I was getting out of the trade at +4 points, and then it ended up going +20, making it to that larger target anyways. So I went back and looked at, all of the trades where I took +4, and if I I did a host of looking back at my trades from this year, and it just seems to make more sense to just keep it the way we used to do it and do a -4 stop, +20 target, and just leave it at that. So if you have questions, drop them in the comments below. I know we went through a lot of different types of trades today. The put hedge, there's the retracements, and then the 15-minute breakout. Those are really the main 3 that I use week after week. But if you have other questions or anything related to those, drop them in the comments, and I hope you have a great week of trading.